Fourth quarters of the year are actually strong or up most of the time. However, this year there's a number of uncertainties that may weigh on the markets. First, we have the Federal Reserve. The Fed has been on the sidelines since they raised rates 0.25% last December, pointing to weak economic data both here and abroad as reasons for waiting to do another raise. That leaves them with the November and the December meetings in which to raise rates one more time. They've indicated their desire to do so. If they do that, then we will have to see how markets react. The last time there was a 0.25 point raise, it was followed by a correction of about 10% over the next 2 months. Secondly, we have corporate profits. Corporate profits have been in a state of contraction for the last 5 or 6 quarters. However, they're expecting to regain their momentum at the last few months of the year. This is because oil prices have actually stabilized, the US dollar has actually stabilized, and there's some top line growth. But the market has actually advanced over the last year, leaving valuations at pretty stretched levels should earnings growth not materialize to the extent that is expected. Thirdly, we have the US presidential election, which is going to be a big wild card. As of now, it appears as though the financial markets are factoring in a Clinton victory. However, should that not happen and a Trump administration takes control, we'll have to see what that means in terms of a reaction from the market in the short term. So in this kind of investing environment marked by pretty stretched US valuations of stocks and still super low interest rates from both offering not much in the way of relative nor absolute yield or real return adjusted for inflation, we think investors need to be more diversified than perhaps they would have been a number of years ago. That means including not only US stocks, but foreign developed and emerging stocks in a portfolio, as well as a variety of fixed income investments, some that would do well in a continued to be low interest rate environment marked by weak economic growth, and some investments that would do better if growth were to pick up and resulting in some type of inflation.